So like I told you, remember this transaction was done by the parent. They like to simplify matter. When the transaction has been done by parent, like I told you, and you have the equity isn't going to be shared. It just goes direct to the group equity. But in case it has been done by the subsidiary, then it has to go to it either has to go to that net assets in working two, or if you haven't done it in working assets in working two, no problem. You just have to make sure that you split it between the non-controlling interest and the what? And the
Mm.
group equity, right?
Okay.
I could tell you this. I think it's important to let you know. You just need to understand. You see, for example, you see this question, when working two. Presume maybe you had the provision for realize the profit. Of course, in this question, we didn't have it, right? We
Yes.
told you if the subsidiary sells, we have to put it. But it's simple. The meaning of placing something here is in case it affected the equity of the subsidiary and it has to be shared, right? Even if you had
Yeah.
forgot to put it here, no problem. But like you can see, I told you the difference between these figures at the acquisition and reporting, the post-acquisition reserve, it is usually shared between group equity and non-controlling what? Interest. You get that?
Yes.
Yes.
Yeah.
So that's the point you should always know. So even if you forgot it here, you can just go direct and apportion it here, right?
Okay. Yes.
So let's go here. Let's go back here. Where were we? We were here. So this entry, remember, it was done by the parent. We were speaking of the parent, Alpha. Alpha is the one who granted those. So that's why it obviously affects the group retained what? Earnings. It doesn't have to be shared in.
Mhm.
Okay, passing the double entries now, what should we do? Like you can see, we debit the expense, right? The expense has a debit nature, but
Yes.
so it's a debit group retained what? Earnings. Group retained earnings by how much? By 8,000, the addition, yes. And then you have to credit the other components of what? Of equity by the same fee,
Mhm.
right? Yes, just like that. So after doing this, let's pass our entry. So debit group retained earnings, let's look for it. It was here, group retained earnings, it's 8,000. Debit group retained earnings. We have the group retained earnings here. We debit it with what? It was a share-based payment, yeah?
Yes.
Share-based payment expense. Even this also attracts the deferred tax, but the question didn't say, so we just ignore that, right?
Okay.
And if they wanted us to do it, we would have done. Okay, so it was 8,000. Let me just write without referencing 8,000. And then we have to do what? Go to the other components of equity.
Okay.
Yes, okay, the higher group, the other component of equity. We could also say here, we could also say
Share base.
payment. We speak of the expense, right?
Yes.
We speak the same thing, negative 8,000, just like that.
Okay.
Yes, yes, yes. Okay, and here I was trying to show how we got this deferred tax, but we had shown it here, right? Okay.
Okay.
I think let me just remove it here. We don't need this deferred tax figure. Okay. So we had done this. That is fine. Hey, what remains? I think nothing remains, right? We are done with these notes already. We just have a draft statement of financial position now to finish up with.
Yes.
Yes.
So we didn't put that deferred tax liability.
No problem, no problem. You need to know about deferred tax liability. Okay, for deferred tax liability, this is what I said, right? Hello?
Yes.
Yes.
Yes,
I
sir.
told you that When we speak of the deferred tax, I told you that we usually just compare the net assets of the company and those of the tax authority.
Okay.
When the net assets of the company are higher than those of the tax authority, it means you have more. When you have more, it means you have to pay more. So if you have to pay more, you are liable for more, right?
Yes, sir.
Deferred tax could be an asset or a what? A liability. And both are usually taken as non-current components. Right. So that's why I told you the question specifically said that these fair value adjustments have the components of deferred tax. So I told you when you have something like this, it's just easy. You see on fair value adjustments here, you have your figure that at the acquisition, this one 60 plus 24 plus 25, right? You take that figure because this is obvious an increase. So in your books, you have increased, but for tax authority, usually they do not increase the fair values. They only charge you when you actually sell the asset, right? So I told you deferred taxes is about the temporary differences. Initially, you and the company, you are allowed by financial accounting means you are allowed to recognize the increase in figures, right? But for tax purpose,
Okay.
that isn't allowed. So if you can recognize an additional value of an asset, it means you increase your net assets. But for the tax authority, it is not allowed until sold. So for the tax authority, nothing will have increased. So that will make the net assets of the company higher than those of the tax what? Authority. You see that?
Really?
Yes. And
Yeah.
so if you have more net assets than those of the tax authority, it means you have to pay more. And that's why for these increases, if you add them together, well, let me add them together first, right? Let me say the summation of from it was 60,000 up to what? Up to 25, eh? Right. If you add them, you get this figure, and then you take this figure and you multiply by the tax rate, which we are told to be 20 per what?
20%.
You get that, right? Of course, it's going to reduce the net asset, so you put it as negative. The same thing here, you see. You could say, let us sum all these. Only the fair value adjustment. Don't do anything else that the question that hasn't told you. 60,000 up to this figure 3,000. You get that. And after getting that, you do the same. You multiply by what? Tax rate, which is 20%, right? You get that again. But also let's put negative what? Negative sign. So this is the tax liability that you'll be having. But now you can see in the books, remember, we had these two figures here because we have the figures at acquisition and at what? At reporting. But in our books, we are dealing with the statement at reporting. That's why the double entry that you will pass in the books will only be for 17,006 what? 600.
600.
We have this deferred tax liability, and as you can see, it has already reduced the figure for what? Net assets. So it should it's like you have debited net assets by 17,600, right? So we do this,
Yeah.
we go on and credit the deferred tax liability in the statement of financial position. I think we did it this time. Let's check.
We
Yes,
did it. We
yes,
did.
yes, we did it right. So
That's okay.
that's what we have to do. You can see that. Right, maybe just write it. Just writing it, we could say, I think it's just like that, right? I hope you got that now.
Yes.
Yes. So since we do not have anything else left, I think let's just proceed with our figures. Whatever we need to compute, we'll compute. Okay, let's start here. Let's start at the top. At the top, we have the property, plant, and equipment. 731, 300, and I think we are done this that day. We are done this on that day. Yes, we added them together, right? They are all here, 731,
Yes, just here when I was going through, where did we find this 310?
310.
Yes.
Then let me check 310. Which one? Which one? Ah, this was in the books, I think. We just copied it. It's here
In
for some.
the
Yeah, yeah,
okay, for
yeah.
better. Okay, thank
So
you.
you say,
Okay.
yeah, where is that? Where is that?
Yes, I was like, but where is it? Yes, but the rest I could see where it was coming from. They
Okay.
were coming from.
Okay.
Yes.
So investment too. I
Okay.
think this investment we dealt with it.
So you've gone.
Hear me now?
Yes, now I can hear you.
Okay. So we had this. I think we dealt with this too. This figure. We are given the breakdown of it, right? Yes, the investment.
Yes.
We have even had it remained with zero, so we no longer have to show this. And for other
Yes, sir.
investments, we also had it. Goodwill, okay, we don't have the goodwill yet, right? So we could just open the bracket here and say working what? Working three. This question is very simple. It doesn't even have the impairment loss of goodwill. You know,
Yes.
question we did it actually has
Eh,
a lot of things. It even had the provision for analyzing profit on non-current assets. Okay, so
good. So are we done? We didn't find the goodwill.
I think maybe I told that I will come later and explain this deferred tax and then to proceed because it's
Yes.
net asset. That's why I think you left it somewhere. But it's just the way of completion. You already have the working. That's why if you have
Yes.
the working, you can always go back at any time there. You see, we have the investment,
Yes.
we have the NCI, you can have our total. So our total just be the summation, right?
Yes, sir.
If you do this work sequentially, if you can do it this way, if you can say I can do this and then I come and finish later, you know that you're not doing things sequentially. You can't even know where you left off. You will even forget what you did. That's why I usually tell you, when you deal with the working, complete it. When you deal with the note, complete it. If you just complete it and record it, even if you stay after the whole year and you come back, you'll be
Okay.
sure. Yes. Apart from that, it will be an issue. Okay, we need the fair value of net asset at the acquisition. I think it's time to compute them now, right?
Yes, sir.
Yes, let's get the total now. Let's get the total figures here. Let's get the total. Okay, so I could just say equals to the summation of all these. I would start from here, from share capital to this, for this deferred tax liability, right? I would have
Yes,
that
sir.
here, and maybe you could just drag it to the right. Drag it downwards to the right, and then I would get
Okay.
the summation of this one, right? If you double click it,
Yes.
it will show you the sign, yes. So I have,
Okay.
so I actually know that my net fair value of net assets at acquisition is how much?
358 for
No, that is at reporting. We need
oh,
at
at acquisition. Yes, yes, sir.
yeah.
267, 200.
Okay, so we have it
Yes.
there. After having it there, I think now it will be also easy. We can get our good.
Yes.
And remember, this goodwill is always goodwill at what?
At
Acquisition,
acquisition.
not that always. So
Okay.
to get goodwill now, we take our total asset to investment, and we have to add because we have the negative sign, so we can just add them. We get how much? 37,300, right?
Yes.
Okay, so I would come here. We don't have any impairment loss. If you had the impairment, you would have had to check that, we'll reduce it there. So we can just say here goodwill. I can either write it or I can point. I can just say equals to, right? I go to that
Yes.
point and I click that and I press enter. So it would show up itself here, the goodwill.
Okay.
As for the
Okay.
brand, I think
We did it.
we were done with the non-current assets. So whatever remains, I think it will be like this brand, for example, we did it ourselves. So we can just
Yes.
say total non-current assets to comply with what has been given. You can just come and copy. They didn't write the word total here. But this is actually the total, right? So it's your choice.
Yes.
You either write the total yourself or you say, okay, I'm going to do what they did. If they are silent, you may also decide to play silent.
Okay.
So you may just say, okay, this is they don't have any right to tell you why you didn't write it out. Why? Why they also didn't write.
Okay.
So you can boast, you can go
Or
on.
maybe they did the total assets, including non and current.
Uh-huh. So if you write this, you can say, okay, I don't have to.
So you've gone.
I've gone. Yes.
Yes.
And us also sometimes you can say, okay, let's do this. Let's say and we are on the current assets, yeah?
Yes.
Current assets. They wrote current assets, so you say, okay, you wrote and I'm also writing. Okay, so
Okay.
I have the current what?
Assets.
Current assets. Current assets, non-current assets. In the exam, you just write it just like they did exactly. So current asset, even for non-current, you could also write here just like they write.
Okay.
You need to give them any reason. They should say you have not been professional. We wrote this and you didn't. We started with the small letter, you put the capital letter. We're going to deduct marks. Okay. So where are we? Okay. We have the inventories, trade receivable, and then the cash. Inventories is 140 and 85, right?
Yes, sir.
Okay, so we could say inventories. Was it just inventory or inventories? Inventories is fine. 140.
Inventories.
Okay, so we could say, okay, open the brackets here. 140,000.
140,000 plus 85,000.
Yes. And here you would also do the same 140 plus
85,000.
done, right? And then we go to the trade what? Receivable.
And receivables.
A 95.70, right?
Yes.
So 95 and 70. So I'll just come here and say 95 plus 70. 95 and 70. So we just
Yes.
95 plus 70. You just have that 157. And then what next? We have the cash and cash equivalent 1613, right?
Yes.
1613. So you have the cash and cash equivalent here. I'll just say
29,000.
16.
16,000 plus 18,000.
Open bracket. I'm just doing on the bracket just so that you can just get a faster picture. And then I add 16 plus.
1,000.
Yes.
18,000.
I think we should also have the total here. So we are going to sum our figures 225. This one will be having 419, right?
Yes.
After that, if you can have the total assets now. You leave they left one space, one row, and then total assets, right? So you can just do
Yes, sir.
what they did. Yes, you leave one row, and then you write here total.
Assets.
Total assets. Equals to you sum this one plus this one, and you have that figure, right? So you have the total assets. And for these, we can delete this row, I think, because we didn't have it. Yes. So let's go on after that. What else do we have? We have the equity and liabilities, right? Yeah, we had
Yes.
we have equity and liabilities. You may just write just like they did, equity and liabilities. And even here at the top, they decided to write to the capital letters. It's not the principle, but we can just decide to do what they did, right?
Okay.
Yes. So you leave with space and you write equity and liabilities here. And liabilities, just like that. And then after that, you have your equity and you get your figures right. So just say there, equity, and then you start getting your figures. Share capital. 240.
Yes.
Yes. So equity, I think you have to add some words. Share capital, share capital. We are told $1. The nominal value of shares was $1 shares.
Yes.
Shares were worth $1. It was 240. Like I told you, you only take the figure for what? For the parent.
Okay.
And here you actually could have done this. I think here, because you are doing consolidation, now you could break down this equity. You could write here group equity.
Why
Group.
are we not,
Why are we not?
if I can ask you a question, why are we not as well adding for the subsidiary?
Remember, what did I say? We compute.
You've gone.
Okay, I'm saying that. Do you remember what I told you on the subsidiary? Hello.
Yes, sir.
What did we speak when you compute the goodwill? What did we say its meaning is on subsidiary? On subsidiary, we said its meaning is you remove investment, you remove investment costs, you replace it with goodwill. You remove net assets of subsidiary, you replace it with what? With non-controlling interest. Yes.
900. Okay, 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 sir. Okay.
Yes. So when you see this goodwill, I usually tell people, and this is usually not stated, but this is the case. When you do something, when you do this doesn't come out of the blue, right? It is very,
Yeah,
you can just put it in double entry. This means that credit investment what?
cost.
Investment cost, right?
Yes.
By how
And
much?
debit
By how much? 234, it's here.
234. Yes.
And then you replace it with goodwill. So debit what?
Goodwill.
Goodwill.
Goodwill. Okay.
By
Okay.
what amount?
234.
37,300. Goodwill is here, 37,500.
700. Yes.
I put it in the wrong side. I mean by 37,300, right? And what do we mean?
Mm.
We are dealing with the net assets. We need to remove the net assets. Debit net assets, which means the equity of the subsidiary. Debit net what? Assets,
Net assets.
which means
Okay.
the equity of subsidiary. Equity of what? Subsidiary.
Subsidiary.
Debit
Okay.
it. By what
Okay.
figure?
By
In
264.
267, right? Yes.
700. Yes.
Yes. You see, what did I do? What did I do? I mean, you have to debit it by this figure, right? And then
Yes.
lastly, you have to recognize non-controlling interest. By what figure now? We have the NCI at the
By
acquisition.
70,
Yes,
7,500.
this is actually the meaning of this, but they don't speak about it. That's why you can see when we are dealing this, we are removing the investment until it became zero, right? And then recognize
Okay.
what?
Yes.
Goodwill.
Can say
And
yes.
then you recognize NCI. Of course, it didn't show directly in the book, but you can see we had the working for NCI, right? We put it here,
Uh,
7,500.
okay.
And that's why
Makes sense.
we removed this. You can say that, okay, I'm removing this 267, and this 267 is here. And it
Yeah.
remember it had the carrying amount which is in the books. You see this 267, it's here. You
Yes.
can see it forms. This is a part of it, 120 and the 60,000. If you come to the books, you look at the share capital. You have the 120 and the 60 and the what? 120 is here.
Yes.
It should be 120
Ah,
and 168, right?
okay.
120 and
Okay.
168, it should be there. If
Yes.
you can see, it's here. Sorry, it
Yes.
is reporting. You can see that, right? It is 120, yeah,
Yes.
right. It's
Yes.
120. So you just get the picture. Although there are some changes because we have the favorable adjustments. Of course, we make the adjustments and what. So you don't have to worry about that. That's
Oh,
why we do not include it, because just by computing goodwill, it means we have discarded it, right?
okay. Yes, sir. Okay.
Yes. Okay, so going on, we have the,
Perfect. Thank you.
okay, retained earnings and other components of equity. I think we had the workings for this. We had the workings, we just need to get the total. And the earnings and other components of equity. We speak of the group now. We have the group retained earnings. We have it here. So I think
Yes.
parents retained earnings.
Didn't
Yes, let's start with the parent retained earnings. It is here, 550, 700, right? Here,
Yes.
550, 700. So I could say 550, 700. We are done.
700.
And then when you go to, okay, we can also take for the other components of equity. Let's just take it because we have it, right? For other components of
Yes.
it's here, 202.
2,000.
Yes, so you can also copy it here, 202,000. Okay, we need the retained earnings. Let's finish up with this. We don't have this, 75% of post-acquisition reserve related to retained earnings. This post-acquisition reserve that is distributed, I told you it is on working two, right? On working
Yes.
two. The main, if you can see,
Different.
yes, because if you can see working two, we get this one, which we need for goodwill at acquisition. But we also do at the reporting so that we simplify matters. We compute the post-acquisition what? Post-acquisition reserve, which
Yes.
equals to the difference. The figure at
Yes.
reporting minus the figure at what? Acquisition.
Addition.
So this is the
Yes.
figure. So the issue that you have to deal with here now is this one, right? You have to deal with this. Remember, if in the parent you have retained earnings and other components of equity, you should be careful on these differences. This difference may wholly be related to retained earnings, or part of it may be retained earnings and part of it may be other components of what? Of equity. So you have to be careful to distribute it. But on this case, I think it's very clear. Let's look. Share capital, 120, 120. Retained earnings. So the first difference is purely due to retained earnings, right? Other
Yes.
components of equity, no difference. You can see other components of equity,
Yes.
no impact, right?
Yes.
These other differences are obvious. This is depreciation, which is obviously related to other components to retained what? Retained earnings, because depreciation affects profit for the year. Profit is part of retained earnings, you see. So you can see all the differences here are due to retained what? Retained earnings. But presume maybe this question gave you maybe here at the acquisition other components of equity was 0, and here maybe it was 1,000. It means there would have been a difference of 1,000 here that is related to other components of what?
Equity.
Equity. So this 91,200, I would have had to distribute it twice. 90,200 would be retained earnings, and 1,000 would be other components of what? Of equity. So when you distribute them here, you would have to know what to put here and what to put here, right? But for this question,
Yes.
it's obvious that this is fully related to what? Retained earnings.
Retained. Yes.
Fully to what? Fully to retained earnings, and the note
So if
other components.
other if OCE also had like also
Let's
he has it
let's
here.
say let's
How?
say it was 1,200, right? In case it was 1,000,
Yes.
it would have been simple because I would have come here on group retained earnings and I would compute here. We said you take current interest, that is 75%, right?
Yes.
Instead of multiplying by 91,200, I would have multiplied by 90,000 only.
Okay.
And here I would do the same. I would say the 75% times
Oh,
1,000. I would have multiplied by that
200.
200. So you just divide it twice. It's simple, right? But
Okay.
here there is
Okay.
nothing, so I multiply by 0, right?
Okay.
Yes, and maybe let's finish up this with the, because when you start breaking this down, we break it between group equity and non-controlling what? Interest. The good thing with non-controlling interest, it is usually shown as a single line item. So you don't, even if there are these components, you don't have to break down into the components, right? You just take it as
Okay.
it is in full because you don't have to explain anything. The
Okay.
parent, actually, the group doesn't care about it, right?
Yes.
Okay, so here I would just say, okay, I would take my 25% of the non-controlling interest, times this whole figure.
91,200.
I would have that one. Okay, so let's get your total. I think everything is done now. So you can have our total. What would it be? I would say equals to summation of here. This is 16,400. 16,400. So the group what? Group equity, retained earnings, retained. And yes, you may be saying this, you may be open the brackets and specify that, okay, I'm doing this, but not that this is on, on which working, it is working for, right? So you may open the
Yes.
bracket and say, okay, if you need this, you can get it. You can just go to working for and find it there. Yes, and you tell them, okay, but it's actual figure. You just go for the actual figure and you take it 610, 400, right?
Yes.
Yes, and then after here, you can see that we have the other components of what? Of equity. So you also say other components of equity, the same working for, right?
Yes.
The same working for, so you also go for, I think we haven't computed it yet. Let's get the total too. You can also go there and get the total.
I've gone.
Hello?
Yes, sir. Now you're back.
Okay, let's get the total two there. So just go there and say, okay, equals to the summation of, and we have our figure is 193,000. So just come here and say equals to 193. It's there. Yes.
3,000.
Yes. What follows is equity. Of course, on here now, we could say
Then
this would be group
retained earnings
retained earnings already, share capital
on a
already.
draft. On our draft.
Earnings on your draft.
Yes, for parent.
I didn't get you. What did you mean?
For parent.
We got that. It's here, retained earnings. We had the group retained earnings. It's here.
Okay. Okay.
Yes. We
Yes, sir.
started
Yes.
with the parent retained earnings, you see, then
Yes. Okay.
25%. Yes. And so
Oh,
you see under equity, we have the group equity and the non-controlling what? Interest.
interest.
The group equity and the non-controlling interest. So we already have the group equity. So we go to the non-controlling what? In interest. Non-controlling interest. Which working is working 5, I do think. So if it's working 5, you also go for it. Non-controlling interest. It's down here. It's down here. I think you can just get the total 2 here. Total. And it should be equal to this one plus this one. I would have 93,300, right?
300. Yes.
So just say equals to 93,300. It's there. So you would have the total equity. Total equity, right?
Yes, sir.
So I would say it's the group equity plus this non-controlling interest, and would have the total equity like that. Okay, after having the total equity now, we do. Okay, why shouldn't we do this? On this, yeah, we need the total assets. I think let's put the total assets on the right here like we usually do. Just say the non-current.
Yes.
Current, we just need to get it there. And let's go down here. We have the equity already. Okay, I think we just have to finish up.
Okay.
We have the non-current liabilities here.
Yes.
Non-current liabilities, 100 and then 70, right?
Long-term borrowing.
So non-current liabilities, long term,
Okay.
long term borrowings, yeah?
Growing, yes.
Okay, let's get that. How much is 100 plus 7? Right.
6.
100?
Time you are going.
I've gone.
Yes. The voice is going.
Okay, it's 170 long-term borrowings, right?
Yes, sir.
Then deferred tax, it's 59 plus 38. Deferred
8, yes.
8. Ah, we already have it
So,
here.
sir, these things where there are no workings, when you add them nicely, also you can get some marks, right?
Yes, yes.
Okay.
Yes, yes, you are right. You know, you're making me laugh. Okay,
Okay.
so it's 59 plus how much? It was 59 plus? I forgot it.
It's
59 plus the 38. Right.
yes.
Plus 38. And then we have, I didn't put the equal sign. Right. You just have that one. What next? What next? You know, you have to finish this.
Yeah.
Okay, let me go to current liabilities direct, right? You know, the problem
Yes.
is I'm acting as if we are on the exam, but that's the problem. Let's go on the current liabilities. What do we do? Let's finish this. You have the trade in the other payable, 60, 52.
Yes. 16, 52.
And the other payable,
Okay.
60, 52. 60.
Yes. Plus 60,000 plus 52,000.
Okay, that's fine. Then what next? What next? What next is short-term borrowings, right?
Yes. 20, 30.
20, 30.
Yes.
Yes, so I think you can just get the total here, total non-current liabilities, right? And
Yes.
you can also get the total liabilities here. Sorry,
Yes.
yes, let's just do this. They are trying to do this to us. Okay, let's get the total. Let's say we need to get the total equity and liabilities. Total what?
Equity and liability.
Yes. How much would it be? I would say equals to, we have the total equity, this one, right?
Yes.
Plus liability, this one, plus current liabilities, this one. Would
Yes.
that one, 1583. Total assets. What did we do here, my friend? I think we haven't added something well here. This is 1583, 300, and this is 1599, 300. There is something we haven't added. You see, there is a clear 16,000 here. Let's roll.
Yes.
Let's look. There is something we haven't. We have. You know, this is the problem of saying we have seconds. Eh?